Bloomberg Audio Studios. Podcasts, radio, news. And Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
One of the big stories that come out of this trip to the Middle East, at least for the Boeing company, Boeing won the single biggest deal in the U.S. plane maker's history with Qatar Airways, placing an order for at least 160 wide-body aircraft during a visit to Doha by U.S. President Donald Trump. So we're going to dig into that story. Sid Philip joins us, Deputy Team Leader for Global Aviation. A good day for Boeing here. What do you make of it, Sid? What's Boeing saying about this?
So Boeing hasn't really said a whole lot about this, but I mean, this is a significant deal for Boeing because they can sort of add another sort of milestone order to their backlog, especially for their 787, which is their sort of state-of-the-art wide-body jet, as well as potentially for the 777X, which is, again, a jet that Qatar Airways has ordered and is still to be certified. And so as airlines sort of look to the next generation of aircraft that they're looking to order, this is sort of, you're going to see these mega deals coming up where everyone's looking to sort of replace their current generation planes with newer models which are more advanced, better fuel economy. And that's sort of great for Boeing in terms of just building out that backlog and sort of selling out aircraft past the end of the decade.
What is the delivery time for something like this? Boeing has clearly had some operational and execution issues.
Exactly. I mean, Boeing's been struggling to deliver both the 787 as well as 737 MAX and get the 777X, which is their latest sort of generation aircraft, certified. So we're still not clear on the details for what the sort of intricacies of this Qatar deal are, but potentially these will sort of play out and go out into the next decade because, I mean, they've got a significant backlog of aircraft that need to deliver in the short term. So this is not going to be an aircraft deal that sort of happens in the next 2 or 3 years. This is going to be a drawn-out deal that goes into the next decade.
Well, stock market likes it. Stock's up 1.4% today. Boeing is hitting a 52-week high. It's up 16.5% year to date. So maybe Boeing's finally digging itself out of its hole from the last several years. So that kind of goes to the big question, Sid. It's all about production, getting planes off and people just said, like George Ferguson from Bloomberg Intelligence says, just focus on the 737 MAX deliveries. That's the number. Is there a sense that Boeing's making improvements there?
We have seen Boeing deliveries inch up, and they've had sort of a milestone in terms of just hitting better production levels on the 737. And we've heard from airline customers, including United Airlines yesterday, saying that the deliveries of 737 MAX are sort of going up and they're waiting on the 787, which is the aircraft that we understand that Qatar Airways ordered. That's also going to be sort of key to getting production and profitability going.
What other kind of pitch can Boeing make to outstrip Airbus? Because in a duopoly market, and I appreciate that China has some smaller players, but if you're dealing with a duopoly, people got to buy your planes.
Exactly. I mean, we have a duopoly at the moment, and
does that change at all, you think?
It sort of has changed a little bit in terms of just the sort of, there's a lot of politics behind aircraft orders again, and that's something that we've seen where Trump's been announcing these mega Boeing orders. I mean, yesterday he announced a deal for 30 planes in Saudi Arabia. And so there is a lot of politics attached to aircraft orders. But at the same time, both Airbus and Boeing are sort of sold out of aircraft until the end of the decade. So it is sort of, you're notching up all these orders, but at the same time, the biggest thing that airlines are talking about is, give me my plane, because that's really the biggest question, where airlines are saying that plane deliveries are delayed, and the Airbus has repeatedly talked about how supply chain issues continue to haunt the industry now 5 years after the pandemic.
Yeah, which I can't imagine. Although, again, what I understand is one of the bottlenecks is labor. Getting this is not just, sitting in an assembly line and hitting a hammer. You got to be really, really skilled labor. And during the pandemic, you lost a lot of that. And retraining these folks or getting new people in it, I'm hearing that's a big problem.
Labor is a major problem, as well as, I mean, just one part being short holds up the entire production line. I mean, you have millions of parts that go into an aircraft, and Airbus and Boeing are the final assembly lines where the plane actually gets put together. But then if parts are not available in the sort of process, you can't actually build those planes. And that's where the bottlenecks come up, because you have smaller suppliers who are struggling financially. You've got parts in short supply. Airbus talks about it's whack-a-mole, where you get one part sorted out and something else breaks. And so it's really a question of getting that supply chain to sort of hum along nicely, and then actually building those planes and delivering those planes, because you've now got record backlogs at both Boeing and Airbus.
So are they exempt from tariff issues?
That's, again, a really important question no one's quite clear about in terms of what the tariff impact is going to be, because for 50 years almost, that the aviation industry has largely functioned tariff-free. And the tariffs added complexity to it, because now everyone's not quite sure if aircraft are exempt. I mean, you've seen like all sorts of industry players and industry groups making representations to President Trump saying that we would like to have tariffs removed on aircraft and aircraft parts. And so we're trying to see where that sort of actually lands up, because potentially aircraft manufacturers and airlines may have to pay tariffs on planes depending on where they're made and what parts they have.
Right, which makes all of this that much more complicated and more difficult. All right, should be great to see you with that. Thanks very much joining us here, Sid Philip, Deputy Team Leader for Global Aviation. We appreciate that. Always good to see you in New York, too. Thank you.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
Alix Steele and Paul Sweeney. We are live here in our Bloomberg Interactive Broker studio in New York City. We're streaming live on YouTube as well. I'm looking at the S&P 500, absolutely flat on the year. So, we were down 13, 14% of the year, peak to trough 20%, climbed up, crawled out of that hole right here, and we'll see where we go from here. Sean OHara joins us, President, Pacer ETFs, joining us via Zoom from Florida. Hey, Sean, what do you do now? I mean, we were really selling off hard. Recession talk was getting pretty heated. Now the president has kind of walked back seemingly some of the tariff uncertainty in the marketplaces, and that seems to be enough for investors to come back into the markets. What are you guys seeing?
Yeah, thanks for having me. I think there was three things that were sort of headwinds into the market earlier this year. One was the tariff stuff. I think, I don't think anybody was surprised that he was going to make an issue of it. I think the severity, if you will, sort of spooked people a little bit. I never thought they were ever going to come in at that rate. I always thought this was going to be a negotiation, and as you see, we are in the midst of a lot of negotiations. I think the second sort of headwind was uncertainty about tax policy, and hopefully that will get itself resolved. And then the third has always been the Fed, and whether they're being too slow in terms of their approach to interest rates. One of those tailwinds, I think, headwinds has turned into a tailwind, and that's the tariff policy. I think we're seeing terrific progress there across the board, and I think we'll continue to see that. Hopefully, Congress will get their act together and they'll get the quote unquote big, beautiful bill done. And then we'll wait and see with regard to what's going with Fed Chairman Powell. So I think the environment has changed from a somewhat dire, oh gosh, we're going to have it in a recession and inflation is going to be horrible because of all these tariffs, to an environment where I think there's less talk of a recession and less concern about the potential inflation regarding tariffs. There is, some good news in this market, and that is that energy prices are down, and energy is a big input to inflation. Yep. We saw a really nice print the other day. So I think you can be somewhat optimistic now, whereas I think earlier with those three headwinds, you had to be a little bit more cautious.
Do we still see the buy the dip mentality?
It's interesting, Alix. We're seeing two different camps here. The big institutional investors and the hedge funders have been net short. And so I'm looking for some kind of a short rally, as they finally capitulate on their short positions. But the retail investor has been really, really strong. And so I think the retail investor is sort of thinking about this differently than the big institutional investors, and putting money in every time they get a chance to. And that's probably, the smarter move in the long run. I mean, in the short run, nobody knows what the market's going to do. But in the long run, over time, you could describe the stock market in 8 simple words. The advance is permanent and all declines are temporary. So we're seeing sort of two camps out there.
So, Sean, as president of Pacer ETFs, where are you guys seeing fund flows? Is it different maybe this week versus a couple of weeks ago when we had companies pulling guidance and, again, real angst in the marketplace?
Well, it's funny, Paul, a couple of weeks ago, our volumes were insane, like 3-4 times the average daily volume on our ETFs across the board. And so that was, to me, a sign of panic in the market. they've now sort of settled down. We're seeing, surprisingly some good flows into international and global as, those markets have done better. I think our global fund is up somewhere around 9 or 10% year to date. I just looked at emerging markets the other day. It's up pretty handily as well. So we're seeing flows there. We're seeing consistent flows into the cash cow series on the value side. So, those are high quality stocks that, generate higher return on assets and trade at a discount. So that's sort of a more conservative quality play. And then we're seeing really significant flows into one of our growth ETFs that uses free cash flow margin. And then there's a little bit of sort of in the financial advisor community, there's really two camps as well. Those that sort of want to tap the brakes a little bit and those that want to put their foot on the gas. For those that want to tap their brakes a little bit, we're seeing flows into some of the risk management strategies that we have.
Interesting. So, I mean, I guess that's how you make a market. I mean, you have two different directions, and then you move around that. Really interesting stuff. Thank you so much, Sean. Sean OHara, president of Pacer ETFs, joining us about all the flows within the market.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies in 130 industries all around the world. We're also privileged to speak to a lot of CEOs from all around the world. And one of us joins us in studio right now, EOS Energy Enterprise. It is a zinc-powered grid-scale batteries. Nice. We know we need updates to the grid. We know we need batteries and storage. And how we make them and where the supply chains are also a key. Now, this company is interesting because it has a U.S. manufacturing plant and supply chain. Joining us now in the studio is the CEO, Joe Mastrangelo. There we go. I got it. Yeah. Welcome. It's good to see you.
Great. Good to see you guys.
So basically, you're looking at a 720% increase in your stock in the last year.
Yes.
What is a zinc-powered grid-scale battery? Let's start there.
Yeah. So when you think about this, think about the battery you see in your car. So we have a plastic enclosure that has the active materials of the battery inside of it. The zinc, bromine-based, water-based electrolyte. Basically, what you're doing, you put a charge in, the zinc and the bromine separate. When the charge goes in, the zinc plates onto a conductive plastic. The bromine is absorbed into a carbonized felt. And then you discharge it. And you can do that anywhere from 2 hours up to 15 hours. It's all common core raw materials, it's highly flexible in its operation, and at scale is very cost competitive.
All right, I'm looking, you are a publicly traded company. I'm looking at your income statement on the Bloomberg terminal. 2024, you had like 15 million of revenue. Consensus looks like the analysts are looking for 160 million this year, maybe 450 million in 2026. What are you guys doing? Tell me your business.
So we are scaling up the manufacturing of our battery modules. So basically we manufacture battery modules that go into an enclosure. The enclosure goes out into the field. It's coupled with some energy source. It could be coupled direct to the grid to help with grid firming or peak shaving. It could be coupled with a power generating source, wind, solar, or traditional fossil fuels, or it could be put on a microgrid for a commercial and industrial application. The growth that you're seeing is basically taking our manufacturing process and going from a semi-automated manufacturing line to a fully automated manufacturing line.
Where is this manufacturing?
So we manufacture in Turtle Creek and outside Pittsburgh, Pennsylvania, and our headquarters is in Edison, New Jersey.
Edison, New Jersey.
There you go. There you go. Is this, you mentioned that's cost competitive at scale. Are you at scale?
We're getting there. So the way we did this was we went in and got the assembly of the battery automated. Now we're doing our upfront parts to automate those. That gets our line to 2 gigawatt hours a year of production. From there, you take the lines. The way we designed this was you cut and paste lines to expand capacity, and we have plans to get our Pittsburgh facility, our Turtle Creek facility, up to 8 gigawatt hours a year in production.
Who's your customer generally? Type
utility scale developers. We also have a large segment now that's emerging with data centers for all the energy needs they have.
Now I get it. This is another play on the AI story. Is that the investment call out there?
It's one of the.
One of. Yeah. Yes.
No.
Well, when you think about it, so it took me a while to understand this, right? So I'm a simple guy, right? So I always saw like, hey, data centers go up and they run and they got power, but there's a lot of fluctuations in the power demands that you have. So we help smooth those out, and we make it more efficient and give them lower cost energy to run their operation.
Which is sort of the whole deal with intermittent power. You need the batteries that go with it. You can have intermittent power, but you need the batteries or a variety.
Right.
Okay, so talk to me about then your costs. How are they looking? Are they coming down when you sign contracts with customers? What does that look like? How hard is it to get to agreements?
Yeah, so on the product cost side, when we designed this battery as a small startup, we only used materials that are used somewhere else. So we basically drafted off of other supply chains and said, there's another supply chain, use that material, don't put anything custom in the battery, because as a small company, we can't afford it. So that allows you, as you scale, the cost comes down. Like, we've taken our cost down from launch of our new product. The cost is down over 75% since we launched the product. When you think about flipping that over to like the sales side, like in an industry, like the miracle of flipping your light switch, there's a lot of technology and a lot of safety that goes into that. Customers want to make sure that the product works. We've gone through the process of qualifying that technology and proving that it works and showing people where it is. So like what we're doing is we go out, we sell the product, show the use case, and when they see the use case in the return, they wind up purchasing. Right now, our backlog in orders stands above $650 million in backlog, with an opportunity pipeline that's over $15 billion.
Wow. How are you capitalizing the company, this growth?
So we're publicly traded. We got an investment last year from Cerberus Capital.
Nice.
Very good strategic partner that's helping us grow. We have a loan from the Loan Programs Office and the DOE, which will help us expand the manufacturing in the United States. And then we're starting to get the company as we scale. And getting back to Alix's question on the cost, is that we're targeting to fund ourselves from operations as we get into 2026.
So you also had a Department of Loan, $303.5 million to fund some new production lines.
Yes.
New administration, different world. Is that loan still intact?
It is. And
Okay.
Look, I think like anybody,
Do you have confidence it'll stay intact?
I do. Well, look, I think when you look at the company, this company had 50 employees in 2018. We have over 600 now. We created 400 manufacturing jobs in an area that lost a lot of manufacturing jobs. It's right down the fairway what we want to do as a country.
So how do you guys, what's the future of the company? Just grow internally? Is that kind of the play?
Yeah, I mean, look, I think there's a lot of opportunities to think a little bit bigger. The way we thought about the strategy of the company is a differentiated battery technology, packaged really well with software around it to optimize operations. When you think about what customers buy, there are other opportunities there, but right now we're focused on get Factory 1 at scale, get Factory 2 launched, and then look from there.
All right, great stuff, great story, Joe. Appreciate you taking a few minutes to come into the studio. Joe Mastenello, he's the CEO of EOS Energy Enterprises, joining us here in our Bloomberg Interactive Broker studio, talking about the smart battery stuff. It's chemistry. I did take chemistry, but not really that good at it, so that's why I went to
Which
Wall
is weird,
Street.
because you like numbers.
Well, I like Wall Street numbers.
Okay, different.
Yeah, like big round numbers. You owe me a bonus of X.
Okay, so that number is
the
clear.
fee I'm charging you for this liquid yield option note is Y. You get paid that.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Remember before all this tariff discussion over the last several months, we were talking about something called AI. That was kind of a big topic for the markets. And we had this DeepSeek come out of China and really throw a wrench into the narrative, which is more tech growth, more growth overall. We're riding this thing to the moon. Then the DeepSeek came out. And let's rethink this a little bit. Let's go revisit that story. We can do that with Austin Carr, Bloomberg technology reporter. He's got the big take story here. It's in Bloomberg Business Week. DeepSeek's tech madman is threatening U.S. dominance over AI. That got my attention. I clicked on it. Austin, talk to us about your column here in Bloomberg Business Week. Talk to us about DeepSeek. What do we know about them and the individual behind them?
So DeepSeek, as you'll recall, gained a lot of attention a few months ago when it released its new R1 reasoning model, as well as another one called V3. And the big deal about this was they sort of claimed to have trained it without access to a lot of the most cutting-edge NVIDIA chips. And they also trained their models for a lot less, at least on the surface, than a lot of the models, equivalent models here have been trained in the US. And that raised a lot of questions about, some of the fundamental notions about how many chips are needed to train these big AI models and how much it's going to cost to develop them. The reason it was also a big deal was just because the startup was sort of very mysterious. There had not been much written about them before sort of January 2025. And we spent a lot of time the last couple months talking to about a dozen former employees that work for this company and its founder, Liang Wenfeng, as well as 40 sources close to the Chinese AI scene, to really just give you a sense of how their sort of market is developing very differently than what's happening in the US, which is they're doing a lot more with less and sort of just trying to innovate despite the constraints that the US has placed on it with all its export controls.
How did he do it? How was he able to undercut the price in such a tremendous way?
Well, I think that's one of the big topics that we explore in the story. We trace it actually back to the history. Liang Wenfeng had started a quant fund back in the about 2015, 2016, and you actually see a lot of those sort of quant sensibilities, looking for efficiencies in the market, which they later applied to their AI models. It was sort of a sort of spin-off of what they were doing with that quant fund that became DeepSeek. One of the big things they did was called mixture of experts. Basically, a lot of the sort of when you used ChatGPT back in the day, you asked it a question, it activated the entire model. So think about it like your entire brain is activated just for the question 2 + 2. What DeepSeek did that was a little bit different was chop it up into what are called experts. So every time you ask a question, it actually routes that to the particular part of the brain that is expert in math or expert in physics or expert in cooking, what have you. So it's a lot more efficient approach, but the downside is it risks hallucinating more or perhaps sending the question to the wrong part of the brain. But that's one of the techniques that they use to really bring this model to life for a lot cheaper and according to the DeepSeek with a lot less or a lot fewer of NVIDIA chips than a lot of the Western players like OpenAI have access to.
I guess one of the things that surprised people, maybe scared some people, is how DeepSeek was able to make so much progress when supposedly all these Western sanctions on technology going to China didn't really seem to slow it down at all. What's the status there?
I think that's one of the big ironies. Actually, incidentally, I had interviewed Jensen Huang from the CEO of NVIDIA in May 2023, and that was the very month, coincidentally, that on the other side of the world, China was getting started with DeepSeek. And Jensen told me at the time, one of his big concerns about export controls is it's actually just going to incentivize Chinese chip makers to work a lot harder to develop chips that can compete with NVIDIA's. But the other nearer-term threat is actually software makers. Sort of their constraints from the sources that we've talked to close to DeepSeek are actually what really drove this company to develop workarounds, do a lot more with less. And that's become a sort of founding DNA of a lot of the Chinese startups that we've talked to. A lot of these, what are called AI dragons across Beijing and Hangzhou that are doing a lot more with a less access to compute. And I think that's, I think the other sort of component of that is they almost have this national pride that we've heard resonate throughout our interviews that really doesn't exist in the US in quite the same way. No one's, quite as excited or, we don't think of Sam Altman necessarily as a celebrity as the same way as in China. People descend on that campus, the DeepSeek office, just to see pictures of him. He's like a national hero there just because he's able to overcome these constraints. And I think that's a really interesting component of the AI scene in China, which we don't have quite in the US.
So about 45 seconds here. What's to prevent the AI companies here in the US doing the same thing that DeepSeek does?
There's really not. I mean, that's one of the things that they did make their models open source for the most part. They did unveil some of their secret sauce, but they didn't quite explain all the techniques and how they did them under the hood. But that said, yes, I mean that was part of the really compelling thing by making this model open source. They really have this ethos. One of the first quotes they put with their first public announcement was "Talk is cheap, show me the code." And so they have this really aggressive, let me prove it to you attitude that I think in the US space with these proprietary models, they're not willing to do. And I think the difference here is that DeepSeek having an open source approach is really putting the pressure on Google and OpenAI to do something similar, or at least undercut the costs of their models. I mean, you can get the same computing power for $36 through DeepSeek as it would cost $1,000 in OpenAI.
All right, Austin, thank you so much. Fascinating story. Austin Carr, technology reporter for Bloomberg News. And you can read all that story on the Bloomberg terminal at bloomberg.com/big take.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg terminal.